Dan Ives just sent a major warning to investors and big tech. According to the Wedbush analyst, this is a wake-up call. Investors are losing patience. In this video, we're going to break down Meta's new AI subscription push, why Wall Street is putting pressure on companies like Meta, Apple, and Microsoft to finally monetize AI, and what Dan Ives thinks happens next. First, I'll show you the full interview clip with Dan Ives from CNBC Closing Bell. Then after that, I'll give you my own detailed reaction and breakdown of everything he said, including why I think this could be a turning point for Meta and the AI trade overall. And finally, I'll reveal 3 of the best stocks I believe investors should be watching closely after this year's sell-off. Let's hear what Dan Ives had to say.
Star analyst Dan Ives here with us to react to a chart that we're going to show you right now, which did get that midday pop, reacting as if this is a major revenue opportunity, is it?
Look, I think after all the CapEx that they're spending, I mean, this is I view it as almost a major step in the right direction because it comes down to 3.5 billion users. How are you going to monetize it? And I think the subscription, they've obviously played around with it. This is what investors want to see. Now it's about how do you monetize the user base. And look, this is not the end step. It's just an interim step as they integrate more and more AI into that user base. That's going to be the monetization. I think that's something where the stock is not reflecting still, I think, some of the revenue opportunities that we'll see over the coming years.
You got 900 outperform. You mentioned investors want to see it. Do users want to see it? Are they going to be willing to pay it? We're only talking about what seems to be, according to some of the reporting here, $3 to $4 a month for a sub for Insta, Facebook, and WhatsApp.
Yeah, you start to get any sort of adoption, you start to now look at revenues that could be up 2, 3, 4%, and then so on as the adoption curve increases. So I think it's something that investors are not really factoring in that they were going to do something like this. I think from a timing perspective, it's maybe come earlier. It shows a confidence in terms of their ability to roll it out. And look, this is going to just be a continued narrative, whether it's Microsoft, whether it's Meta, whether it's Apple. How are you going to monetize AI? Chip companies have shown how they're going to monetize, just like software.
Yeah, but you're talking, okay, that's interesting how you say it reflects a confidence on their part to do this. Some may look at this and suggest that it shows they're, a little late to the game on how they're going to monetize AI beyond their core ad business, and you just throwing a bunch of stuff at the wall and seeing what sticks. Because Zuckerberg apparently at this shareholder meeting also said, or at least he opened the door for a cloud business. Is that a moonshot or is that legit?
Look, I think cloud, obviously that could be maybe a bit more of a moonshot, but to me it's, okay, how do you slowly diversify away on the advertising side? Advertising, that's going to continue to be obviously bread and butter. But you look at what they're doing, it's going to continue to be diversification. And I view that as a positive because their install base is unmatched. So as they monetize it, part of our bullishness in terms of, where I talk about $900 and ultimately, what could be higher, this is the key prove-it year for Zuckerberg and Meta. It's a step in the right direction after obviously a quarter where it was all about CapEx, and obviously that was more of a dog ate the homework type of conference call.
Well, let me ask you this, because as you were talking, I was looking at stock, so it's down almost 4% year to date. How much pressure do you think they're feeling inside that building? And how much pressure is he feeling himself, Zuckerberg, to deliver something that's going to wow the market and wow investors back into the name? Because outside of Microsoft, which is down as well on the year, everything else seems like it's a pretty good story to tell. Outside of these two.
Pressure is definitely building because when you're spending 120, 130 billion from a CapEx perspective, they need to now show. And I think that the wake-up call was the last earnings call. Because when you contrast that with Amazon and obviously others, for Meta, that's kind of putting Meta in the investor penalty box. You guys start to show it. Next 2-3 quarters, this stock's either at 750, 800, or it's where it is or lower. The point is, this is kind of a fork in the road period, in my opinion, for Meta, but a step in the right direction in terms of it rolling this out.
But they keep finding themselves in the penalty box. You know what I'm saying? Like, it wasn't just after this last quarter. It was like 2 quarters ago, they were in the penalty box with a major penalty before. Like they can't stay out of the box. How do they stay out of the box?
Look, and I think for them, that's the quagmire, because they're trying to really turn around a cargo ship in a river. I mean, they're trying to make a massive transformation while investors are obviously watching every single move. When you think about the hyperscalers or chip companies, they're kind of front and center in terms of ones that are going to benefit from AI. Meta, we'll see Apple in a few weeks. You look at Microsoft when it comes to, one where it's still guilty till proven innocent. Mm-hmm. These are the names now that now need to show. It's not just about talk, it's about execution.
Real quick. Apple, new high. You just mentioned WWDC will be there, so that stock's up. And how much pressure is on Salesforce tonight with their earnings?
I mean, from a pressure level, if there's pressure on Meta, there's even double the pressure on Benioff and Salesforce, because it comes back to backs against the wall. I think they ultimately start from an agent force perspective. Can you get that over, ultimately to a point where it could be 3-4% of revenue? But this is a prove-it period. Look at Zscaler, they're here. Look at CrowdStrike and Palo Alto on the other side. That's why fork in the road period for tech. Key few months ahead, key earnings night ahead for software.
All right, Ben.
What makes this Dan Ives interview so interesting is that it is not really just about Meta introducing subscriptions. The bigger story here is the pressure building inside big tech to finally prove that all this AI spending can actually turn into real money. And honestly, that is the conversation the market has been waiting to have for months now. Dan Ives immediately frames Meta's new subscription move as a major step in the right direction. He is basically saying, look, Meta has already spent enormous amounts of money on AI infrastructure, data centers, chips, and long-term AI development. At some point, investors stop caring about the vision and start asking one simple question: where is the return? That is really the heart of this entire interview. Meta has around 3.5 billion users across Instagram, Facebook, and WhatsApp. That number is almost impossible to comprehend. When you have an ecosystem that massive, even a tiny amount of monetization can become a huge revenue stream. And that is exactly what Dan Ives is getting at when he talks about charging maybe $3 or $4 per month for premium AI-enhanced features. Now personally, I actually think this is a smart move from Meta. Not because subscriptions themselves are revolutionary, but because Wall Street needs evidence that Meta can evolve beyond just digital advertising. Advertising built the company, but investors now want to see AI become an entirely new revenue engine. And what stood out to me during this interview is how Dan Ives keeps emphasizing that this is only the beginning. He repeatedly says this is not the end step, it is just an interim step. In other words, the subscription itself is not the final product. The real opportunity is integrating AI deeply into the daily habits of billions of users. Think about that for a second. If Meta eventually creates AI assistants embedded directly into Instagram, WhatsApp, Facebook, Messenger, and maybe even future wearable devices, then suddenly AI becomes part of people's everyday lives. At that point, monetization becomes much easier, because users are no longer paying for a novelty. They are paying for convenience, productivity, entertainment, and personalization. And honestly, I think that is where the market may still be underestimating Meta. A lot of investors are comparing Meta to companies like Nvidia or Broadcom that are already printing money from AI infrastructure demand. But Meta is playing a completely different game. Nvidia sells the picks and shovels during the AI gold rush. Meta wants to own the digital world where consumers actually use AI every day. That takes longer to build. Dan Ives also points out something very important. Even small adoption rates could meaningfully boost revenue growth. If only a fraction of Meta's billions of users subscribe, revenue could rise by 2, 3, maybe even 4% over time. And on Wall Street, incremental revenue growth at Meta's scale matters a lot. Because when you are already generating hundreds of billions in revenue, adding even a few percentage points can translate into massive cash flow increases. But then the interviewer pushes back, and this is where the conversation gets really interesting. The interviewer basically questions whether Meta is late. And honestly, I think that is a fair criticism. The AI race has moved incredibly fast. Microsoft partnered with OpenAI early. Nvidia became the king of AI chips. Amazon continues building cloud dominance. Google is aggressively integrating Gemini across its ecosystem. Meanwhile, Meta has spent heavily but still has not fully convinced the market how all this spending turns into profits. So when Meta suddenly starts experimenting with subscriptions and discussing cloud opportunities, skeptics naturally wonder if they are throwing ideas at the wall hoping something sticks. Dan Ives tries to defend this by arguing that diversification itself is positive. He says Meta is trying to slowly reduce dependence on advertising revenue, and I agree with that. The problem is that diversification sounds great in theory, but investors want execution, and that is the word that kept popping into my head throughout this interview. Execution. That is the challenge for Meta right now. Nobody doubts that Zuckerberg is ambitious. Nobody doubts Meta has scale. Nobody doubts they have engineering talent. But investors are no longer rewarding promises, they want proof. Dan Ives even calls this a fork-in-the-road period for Meta, and I think that is probably the most important statement in the entire interview, because he is essentially saying the next 2 or 3 quarters are critical. Meta cannot just keep talking about AI forever while spending over $120 billion in capital expenditures. Eventually, investors expect visible returns. They want to see monetization growth. They want to see user engagement improvements. They want to see enterprise AI opportunities. They want to see higher margins. Otherwise, the stock risks staying stuck or even falling lower. And honestly, I think Wall Street's patience with AI spending is starting to shift across the entire tech sector. Last year, investors were willing to reward almost any company that mentioned AI. But now we are entering the next phase of the market cycle. Now the question becomes, who can actually turn AI hype into sustainable profits? That is why Dan Ives mentions that chip companies have already proven how they monetize AI. Nvidia does not need to explain the business model anymore because the demand is obvious. The same goes for some cloud providers. But consumer-facing AI companies still need to prove the economics work at scale. And this is where Meta becomes fascinating, because if they succeed, they could create one of the largest AI monetization ecosystems on Earth. But if they fail, investors may start viewing all this spending as excessive. One thing I found particularly interesting was when Dan Ives described Meta as being in the investor penalty box. That phrase perfectly captures the current market psychology around the company. Meta keeps finding itself under pressure after earnings reports because expectations are so high, and the interviewer actually challenges him on this by saying Meta seems unable to stay out of the penalty box. One quarter investors are worried about spending, another quarter they are worried about monetization, then another quarter they question strategic direction. That back and forth uncertainty creates volatility in the stock. Dan Ives responds with an analogy that I actually thought was very accurate. He says Meta is basically trying to turn around a cargo ship in a river. That is a great visual. Meta is not a small startup that can pivot overnight. It is one of the largest technology companies in the world with billions of users, massive infrastructure, huge advertising operations, regulatory scrutiny, and shareholder expectations. Transforming a company that large into an AI-first business takes time. And personally, I think many investors underestimate how difficult that transformation actually is. People see the AI boom and expect instant results, but integrating AI across a global ecosystem with billions of users is incredibly complex. At the same time, though, investors are not wrong to demand accountability, because $120 to $130 billion in capital expenditures is enormous. That level of spending creates pressure internally and externally. Every quarter that passes without clear monetization raises the stakes even further. Another major point Dan Ives makes is that companies like Meta, Apple, and Microsoft are now in the guilty until proven innocent category when it comes to AI monetization. That line really stood out to me. In other words, the market is no longer giving these companies automatic credit for simply participating in AI. They now have to demonstrate measurable success. And I think that is going to define the next chapter of the AI market. The easy part was announcing AI initiatives. The hard part is proving those initiatives generate durable profits. Then, toward the end of the interview, the conversation shifts briefly toward Apple and Salesforce, which actually reinforces the broader theme here. Apple is approaching WWDC with enormous expectations surrounding AI integration into the iPhone ecosystem. Salesforce is under pressure to prove enterprise AI demand can accelerate growth. So this is not just a Meta issue, this is becoming an industry-wide pressure test. Who actually wins the monetization race? Who turns AI into recurring revenue? Who just burns cash chasing the trend? That is really what the market is trying to figure out right now. And personally, I think we are still early in this story. I do not believe the winners of the AI era will simply be the companies with the best models. I think the biggest winners will be the companies with the strongest ecosystems and distribution. That is why Meta remains so dangerous competitively despite all the skepticism. 3.5 billion users is an unbelievable strategic advantage. If Meta successfully integrates AI into social media, messaging, advertising, content creation, wearable wearables and commerce, the revenue opportunity could eventually become massive, but the key word is if, and that is exactly why this interview matters. Dan Ives is essentially making the bullish case that Meta is finally starting to move from spending mode into monetization mode. The market is cautiously optimistic, but investors still need proof over the next few quarters. So this interview was not really about subscriptions alone. It was about whether Meta can justify one of the biggest AI spending campaigns in corporate history, and over the next year, we are probably going to find out. Now let's dive in and break down 3 beaten-down stocks that could deliver massive long-term upside after this year's sell-off. These are companies dominating massive industries, expanding their competitive advantages, and quietly positioning themselves for the next phase of growth while investors focus on short-term fear. The first stock on this list is Uber Technologies Inc., ticker symbol UBER. Now, when most people hear the word Uber, they immediately think about ride-sharing. They think about opening an app to get from one place to another. But I think a lot of investors still underestimate what Uber has quietly become over the last several years. This is no longer just a ride-hailing company. Uber is building one of the largest logistics and mobility ecosystems in the world. And once you really understand that, you start looking at the company very differently. The reason Uber matters so much today is because transportation is one of the biggest recurring spending categories globally. People need transportation every single day. Businesses need delivery infrastructure every single day. Consumers increasingly want convenience delivered directly to their doorstep. Uber sits directly in the middle of all of that. And what makes the business powerful is the network effect. The more riders Uber has, the more drivers join the platform. The more drivers join, the faster the wait times become. Faster wait times improve customer satisfaction, which attracts even more users. Then Uber layers food delivery, grocery delivery, memberships, advertising, and business partnerships on top of that ecosystem. That flywheel becomes very difficult to compete against at scale. And despite all the competition over the years, Uber still remains the dominant global ride-hailing platform. Between 2021 and 2025, Uber more than doubled its gross bookings from about $90 billion to nearly $194 billion. That is an incredible expansion in a relatively short period of time. Monthly active platform consumers also exploded from 118 million to 202 million users during that same period. Think about that growth for a second. Over 200 million people now actively use Uber's platform. That scale matters because scale lowers costs, improves efficiency, strengthens the network effect, and increases monetization opportunities. Trips on the platform also surged from 6.4 billion to 13.6 billion. That means people are not just signing up for the platform, they are using it more frequently. That is one of the most important indicators for any platform business, user engagement. And this is where I think Uber's story gets even more interesting. A lot of investors still view Uber through the lens of its old unprofitable years when the company was burning enormous amounts of cash trying to gain market share. But Uber today is a completely different company compared to the Uber of 5 or 6 years ago. Today, Uber is generating real profits, real cash flow, and improving margins. Revenue growth remains strong, but now the business is becoming more disciplined operationally. Uber recently reported quarterly revenue of over $13 billion, growing more than 14% year over year. The company's profitability metrics have improved significantly as management focuses on higher margin opportunities beyond rides alone. And one of the smartest moves Uber made in recent years was launching Uber One. I think Uber One is honestly one of the most underrated subscription businesses in tech right now. Uber One gives users benefits like discounts, reduced fees, and premium perks across rides and deliveries. That subscription service has already reached around 50 million members. 50 million, that is massive. Subscription businesses are powerful because they increase customer loyalty while generating recurring revenue. Once customers become part of a subscription ecosystem, they tend to spend more frequently and stay within the platform longer. It is the same reason so many tech giants aggressively push subscriptions today. And here is where things become even more compelling from an investment perspective. Uber is not just relying on rides and deliveries anymore. The company is aggressively building an advertising business. Now at first glance, advertising inside Uber's ecosystem may not sound exciting, but think about how valuable Uber's platform data actually is. Uber knows where users travel, where they eat, when they shop, and what services they use. That creates highly targeted advertising opportunities for restaurants, grocery stores, retailers, and brands. Sponsored listings, merchant promotions, in-app ads, and even even advertising inside vehicles could become a significant high-margin revenue stream over time, and personally, I think this part of the business could surprise investors over the next several years, because advertising margins are typically much higher than transportation margins. That means Uber's profitability profile could improve dramatically as advertising grows. At the same time, Uber continues expanding internationally and pushing deeper into suburban markets. Many people assumed Uber's growth story would slow down after major city expansion matured, but the company keeps finding new ways to grow user engagement globally. Another thing I find interesting about Uber is how resilient the platform has become during uncertain economic periods. Even when consumers pull back spending in some areas, transportation and delivery remain essential services for many people. That gives Uber a level of recurring demand that many other growth companies simply do not have. Now let's talk valuation, because this is where the opportunity becomes really interesting after the sell-off. Despite Uber's growth, improving profitability, massive scale, and dominant market position, the stock still trades at valuation levels that many investors would normally associate with slower-growing businesses. Analysts expect Uber's revenue and adjusted EBITDA to continue growing strongly over the next few years. Revenue is projected to grow at around 13% annually through 2028, while adjusted EBITDA growth could reach roughly 23% annually. That gap matters. When earnings growth outpaces revenue growth, it usually means the business is becoming more efficient and profitable over time. And honestly, I think Wall Street may still be underestimating Uber's long-term operating leverage. As the platform matures, Uber does not necessarily need costs to grow at the same pace as revenue. More trips, more subscriptions, more advertising, and higher engagement can all drive stronger margins. That is where compounding really starts accelerating. And then there is the autonomous vehicle angle. Now I know autonomous driving gets overhyped sometimes, but this could genuinely become one of the biggest long-term catalysts for Uber if the technology matures successfully. Imagine a future where Uber's network integrates autonomous fleets at scale. Transportation costs could potentially decline while margins improve dramatically. Even today, Uber is already positioning itself strategically through partnerships and technology integration. The company does not necessarily need to build the cars themselves. Uber's biggest advantage is its platform, demand network, logistics infrastructure, and customer relationships. That is extremely valuable. And personally, I think Uber's management deserves more credit than it gets from investors. For years, critics said the business model would never work profitably. Critics said competition would destroy margins. Critics said the company would burn cash forever. But Uber adapted. The company streamlined operations, improved efficiency, expanded vertically, and turned itself into a real cash-generating platform business. Now, of course, there are still risks. Competition remains intense. Regulation is always a concern in multiple countries. Economic slowdowns can impact discretionary spending, and autonomous vehicle disruption could eventually reshape the industry in unpredictable ways. But when I look at Uber today, I see a business with global scale, powerful network effects, recurring demand, improving profitability, multiple revenue streams, and long runway growth opportunities. And after the recent sell-off, the stock looks much more attractive than it did at previous highs. Sometimes the market gives investors opportunities to buy quality businesses during periods of fear and uncertainty, and I think Uber fits that category right now, especially for long-term investors willing to think 3, 5, or even 10 years ahead. Because if Uber continues executing the way it has recently, this company could eventually evolve into something much larger than just a transportation app. It could become one of the dominant global mobility and logistics platforms of the modern economy. And honestly, I think many investors still have not fully realized that yet. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock on this list is MercadoLibre, ticker symbol MELI, and honestly, this company might be one of the strongest long-term growth businesses that many North American investors still do not fully understand. When people think about massive technology opportunities, they usually focus on the United States, artificial intelligence, cloud computing, or semiconductors, but one of the biggest secular growth opportunities over the next decade could actually come from the continued digital transformation of Latin America. And MercadoLibre sits directly at the center of that transformation. This is not just an e-commerce company, this is an entire digital ecosystem. MercadoLibre operates one of the largest online commerce platforms in Latin America. But what makes the business so powerful is how deeply integrated its ecosystem has become. The company has built payments infrastructure, logistics networks, digital banking services, credit products, advertising, and merchant tools all connected together inside one platform. That creates an incredibly sticky business model. The more consumers shop on MercadoLibre, the more merchants want to sell there. The more transactions happen, the more valuable the payment ecosystem becomes. The stronger the payment ecosystem becomes, the more financial services opportunities emerge, and once that cycle starts compounding, it becomes extremely difficult for competitors to disrupt. This is why I think MercadoLibre is not just benefiting from e-commerce growth, it is benefiting from the entire modernization of financial infrastructure across Latin America. That is a much bigger story. In many parts of Latin America, millions of consumers remain underbanked or underserved by traditional financial institutions. MercadoLibre saw that gap early and aggressively expanded its fintech business through Mercado Pago, and this may actually be the company's most important long-term growth engine. Mercado Pago allows users to make payments, transfer money, access credit, manage digital wallets, and participate in the digital economy far more easily than before. As adoption grows, MercadoLibre gains deeper relationships with both consumers and merchants. This creates powerful customer retention. And personally, I think this is where MercadoLibre's moat becomes incredibly underestimated, because once a company controls commerce, payments, logistics, and financial services together, switching away becomes much harder for users. The ecosystem starts reinforcing itself. Now let's talk scale, because MercadoLibre's numbers are honestly very impressive. The company's revenue has grown at an extraordinary pace over the last several years. Net revenue recently surged past $5 billion quarterly, representing strong year-over-year growth despite macroeconomic challenges in several Latin American markets. That kind of growth at MercadoLibre's size is remarkable. But what really stands out to me is the consistency. Many companies can grow quickly during favorable economic conditions. Very few companies can continue expanding while dealing with inflation, currency volatility, political uncertainty, and changing consumer conditions across multiple countries. MercadoLibre has proven surprisingly resilient through all of that, and I think a lot of that resilience comes from the fact that the company is solving real structural problems. In developed economies, people often take things like digital payments, fast shipping, and online financial services for granted. But in emerging markets, those systems are still evolving. MercadoLibre is helping build that infrastructure. That creates enormous long-term opportunity. The company now serves tens of millions of active buyers across the region, while payment volumes through Mercado Pago continue growing rapidly. Total payment volume recently exceeded $50 billion quarterly, showing how quickly digital financial adoption is accelerating. That is huge, because financial services businesses tend to become extremely profitable at scale. And unlike traditional banks burdened by legacy infrastructure, MercadoLibre built its ecosystem digitally from the ground up. That gives the company speed, flexibility, and efficiency advantages. Another major advantage MercadoLibre has is logistics. One of the biggest barriers to e-commerce adoption in emerging markets has always been delivery infrastructure. Consumers need fast and reliable shipping to trust online commerce. MercadoLibre invested aggressively for years building fulfillment centers, shipping capabilities, and logistics systems throughout Latin America. At the time, some investors worried the spending was excessive. But now those investments are becoming a competitive weapon. Faster shipping improves customer satisfaction, increases repeat purchases, and strengthens the overall ecosystem. It also makes the platform more attractive to merchants who want reliable fulfillment solutions. And honestly, this reminds me of what we have seen historically with some of the world's best platform businesses. The companies willing to invest aggressively in infrastructure early often dominate later because smaller competitors simply cannot replicate the scale efficiently. Another thing I really like about MercadoLibre is management's long-term mindset. The company has consistently focused on expanding its ecosystem instead of maximizing short-term profits at the expense of growth. That approach requires patience from investors, but over time it can create much larger businesses. And I think the market is beginning to appreciate that more now. MercadoLibre's profitability has improved significantly while growth remains strong. Operating margins have expanded as scale efficiencies kick in across commerce, logistics, and fintech operations. That combination is powerful. High growth plus improving profitability is usually where some of the best long-term investments are found. Now let's address the elephant in the room because there are definitely risks with MercadoLibre. Latin America can be volatile economically and politically. Currency fluctuations can impact results. Inflation pressures can affect consumer spending. Regulatory changes remain possible across multiple countries. Those risks are real, but sometimes investors overfocus on short-term regional volatility and underestimate the long-term structural opportunity underneath it. And personally, I think that may be happening with MercadoLibre, because if digital commerce and digital payments continue growing across Latin America over the next decade, MercadoLibre is positioned almost perfectly to benefit from both trends simultaneously. That is incredibly rare. The company is not dependent on a single business segment. Commerce fuels payments. Payments fuel financial services. Financial services increase engagement. Engagement drives more commerce. Everything works together. That ecosystem strategy is one of the main reasons I think MercadoLibre could continue compounding for many years. And another thing investors should not ignore is advertising. As MercadoLibre's platform scales, advertising becomes increasingly valuable to merchants wanting visibility inside the marketplace. Sponsored product listings and advertising tools could become another major high-margin revenue stream over time. Again, this improves profitability. One thing I have personally noticed about great long-term compounders is that they often start with one dominant business, then gradually layer additional monetization opportunities on top of the ecosystem. MercadoLibre is doing exactly that. Payments, credit, advertising, logistics, commerce, digital banking. Each additional service strengthens the overall platform, and after the recent sell-off, I think the stock has become far more interesting for long-term investors willing to look beyond short-term volatility. Because when fear hits the market, high-quality growth companies often get pulled down with everything else regardless of long-term fundamentals. That creates opportunity. Now, I am not saying MercadoLibre will not experience volatility going forward, because it absolutely will. This stock has historically been volatile, and emerging market exposure adds additional uncertainty. But volatility and risk are not always the same thing. Sometimes volatility simply creates opportunities to buy exceptional businesses at more attractive prices. And honestly, I think MercadoLibre belongs in the conversation of elite long-term global growth companies. The digital economy across Latin America is still developing. Millions of consumers are entering online commerce and digital finance ecosystems for the first time. MercadoLibre continues strengthening its infrastructure, expanding services, and deepening customer relationships across the region. That runway could last for many years. And if management continues executing the way it has historically, I would not be surprised at all if MercadoLibre becomes significantly larger over the next decade than most investors currently expect. Because this company is not just riding a trend, it is helping build the future financial and commercial infrastructure of an entire region. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third and final stock on this list is Opendoor Technologies, ticker symbol OPEN. Now this one is easily the most controversial stock in today's video. Unlike the first two companies we discussed, Opendoor is not a proven dominant giant with years of consistent profitability and massive investor confidence. In fact, many investors have completely written this company off after the brutal collapse in the housing market and the stock's massive decline from its previous highs. But sometimes the biggest opportunities in the market come from companies that investors are too scared to even look at anymore. And Opendoor is one of those companies that could either become a massive comeback story or continue struggling if the housing market weakens further. That is why this stock is higher risk. But it is also why the upside potential could be enormous if things finally turn around. Now, before we talk about the risks, let's first understand why this business matters in the first place. Buying and selling a home is one of the most stressful and inefficient processes most people will ever go through financially. The traditional home selling process is slow, uncertain, full of negotiations, inspections, paperwork, agent commissions, and delays. Sellers often wait weeks or months just to close transactions. Opendoor's entire mission is to simplify that process. The company uses technology, pricing algorithms, and large-scale operational infrastructure to buy homes directly from sellers and then resell them efficiently. Instead of waiting months for buyers, sellers can receive near-instant offers through Opendoor's platform. That convenience is the core value proposition. And honestly, I think many people underestimate how valuable convenience becomes in huge industries filled with friction. People pay for simplicity, they pay for speed, they pay to avoid stress. And the real estate market has historically been one of the most outdated industries when it comes to customer experience. That is the opportunity Opendoor is chasing. Now obviously the challenge is that housing is an incredibly cyclical business. When mortgage rates exploded higher and housing demand weakened, Opendoor got hit extremely hard. The company was forced to deal with declining home values, lower transaction volumes, tighter margins, and investor fears surrounding its business model. The stock collapsed, and this is where things become interesting from an investment perspective. Because when a stock gets crushed that badly, the market often starts pricing in worst-case scenarios. At one point, investors were questioning whether Opendoor's entire business model could survive. But despite all the fear, the company is still operating, still processing transactions, still improving efficiency, and still attempting to position itself for a future housing recovery. That matters. One thing investors need to understand is that Opendoor operates in an absolutely massive market. The residential real estate market in the United States alone represents trillions of dollars in annual transaction value. Even capturing a small percentage of that market could create a very large business over time. And unlike traditional real estate companies, Opendoor is trying to scale through technology and automation. That creates long-term upside potential if execution improves. Now personally, I would never categorize Opendoor as a low-risk investment. This is not the type of stock you blindly buy without understanding the risks involved. But after major sell-offs, sometimes investors should at least pay attention to businesses where sentiment has become extremely negative while operational improvements quietly continue underneath the surface. And that is what makes Opendoor interesting to me. The company has aggressively reduced costs, tightened operations, and shifted toward a more disciplined approach after the housing downturn exposed weaknesses in the business model. Management understands they cannot simply prioritize growth at all costs anymore. They need efficiency, they need smarter inventory management, they need better risk controls. And honestly, I think the market sometimes respects companies more after they survive difficult periods because those experiences force management teams to become more disciplined operators. Now let's talk about the potential recovery angle because this is where the bullish thesis really comes into play. If interest rates eventually stabilize or decline over time, housing activity could gradually recover. Pent-up demand from buyers and sellers who delayed moving during the high-rate environment could begin returning to the market. And if transaction volumes recover meaningfully, Opendoor could benefit significantly because its business is highly tied to housing activity. That operating leverage cuts both ways. It hurts badly during downturns, but it can also create explosive upside during recoveries. This is one reason why some investors still view Opendoor as a speculative turnaround opportunity rather than a broken business. And remember, consumer behavior is slowly shifting toward digital convenience across almost every major industry. Banking became digital, shopping became digital, transportation became app-based, food ordering became app-based. Real estate may eventually continue moving further in that direction as well. That does not guarantee Opendoor wins long-term, but it does support the broader thesis that technology-driven real estate platforms could become more important over time. Another thing that makes Opendoor intriguing is data. The company processes enormous amounts of housing market information, pricing trends, transaction behavior, and regional demand patterns. Over time, better data and improved algorithms could strengthen pricing accuracy and operational decision-making. That could improve margins and reduce risk. Now, of course, this is where skeptics will argue that housing markets are too unpredictable for algorithm-driven home flipping to work consistently. And to be fair, that criticism is understandable after what happened during the recent housing downturn. But I think the key question investors should ask is not whether Opendoor's early model was perfect. Clearly it was not. The real question is whether the company can adapt, improve, and survive long enough to benefit from future housing normalization. Because if it can, the upside from these beaten-down levels could potentially be very large. One thing I personally find fascinating about the market is how quickly narratives change. When housing was booming, investors treated Opendoor like the future of real estate. Then rates surged, housing slowed, and suddenly many investors acted like the company had no future at all. Reality is usually somewhere in the middle. And sometimes the best opportunities come from identifying situations where fear may have become excessive relative to long-term potential. Now let's be clear. Opendoor is not the same type of business quality as the first two companies discussed in this video. Uber and MercadoLibre have stronger competitive positions, stronger profitability profiles, and more diversified growth engines. Opendoor is the speculative play here. But speculative does not automatically mean bad. It simply means higher uncertainty combined with potentially higher reward. And for investors comfortable with volatility and turnaround situations, Opendoor could be worth watching closely over the next several years, especially if the housing environment improves, because if transaction volumes rebound and Opendoor executes operationally far better than it did during the last cycle, investor sentiment could shift dramatically. And when sentiment shifts on heavily beaten-down growth stocks, the rallies can sometimes be explosive. That is why I think Opendoor deserves a place in this conversation about stocks to watch after the sell-off. Not because it is guaranteed to succeed, but because the market may already be pricing in far too much pessimism. Now, when I look at all three companies we discussed today, what stands out most to me is that each one benefits from long-term structural trends. Uber benefits from the growth of digital mobility, delivery ecosystems, and platform logistics. MercadoLibre benefits from the rise of digital commerce and fintech adoption across Latin America, and Opendoor benefits from the continued digital transformation of real estate transactions. All three companies also experienced major stock volatility and investor skepticism at different points. But sometimes great investing opportunities emerge when strong long-term themes collide with short-term fear. That is often where mispricing happens. Now, obviously not every beaten-down stock recovers. Some companies deserve to fall. That is why research and risk management matter so much. But for long-term investors willing to study businesses carefully and think beyond short-term headlines, sell-offs can create opportunities that simply do not exist during euphoric bull markets. And personally, I think we are entering a period where selective stock picking will matter far more than blindly chasing hype. The market is becoming more focused on execution, profitability, competitive advantages, and durable growth. That is exactly the kind of environment where patient investors can outperform over time. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. And now I want to hear from you. Which of these three companies do you think has the strongest long-term future? Uber, MercadoLibre, or Opendoor? And which one do you believe has the biggest upside potential over the next 5 years? Let me know your thoughts down in the comments because I would genuinely love to hear your perspective. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next video YouTube suggested here.